All right, good afternoon, everybody. How are we doing here? If I can just get a quick audio and video check, let me know that we are coming through, that you can hear me and see my screen. Let's take a look here. There we go. All right, perfect. Audio and video, good. All right, well, good. I appreciate everybody joining us today. Hope everybody's having a great trading day and trading week. We are doing our webinar today on Wednesday. We normally do Thursdays, but we moved the schedule around a little bit, so I appreciate everybody being with us. And today we're going to do a very, very basic webinar on the ultimate hedge strategy using Nadex Spreads. Some of you might have heard us do multiple webinars on this in the past, some very in-depth, some very detailed. We recently did a live event teaching the strategy very in-depth. There's a lot to it. I'm going to basically cover just the basics today, okay, to help you get an idea of this. And I'll show you where you can get some more information, and we'll build on it as well. So let's get our disclosures knocked out here. As always, trading futures options or any financial instrument involves risk, may not be suitable for every investor. Also, guys, I might show you a couple examples of some trades today. I might draw on the chart. I might do some trades on the Nadex demo platform to help you visualize and understand the strategy I'm teaching you. Keep in mind, those are not live trades. Those are in demo. Those are in no way trading advice or a trading recommendation of any kind. Okay, it's just simply me trying to help you visualize what I'm teaching you, show you how to execute trades in the platform. In no way trading advice. Any decisions you make are your sole responsibility. Okay, so if you're brand new to Nadex, make sure to hop on over to nadex.com. You can get some great information about, who Nadex is, what they have to offer. Basically, Nadex offers binary options and spread options. You can go through these two tabs here, get some great information on that, get some of the market specs here, get some market news here, kind of what's going on in the market, maybe help you formulate some ideas how to take advantage of some things there. Trading platforms, Nadex has, you can go directly to their online trading platform. But right here, demo trading platform. If you don't have one of these, grab one of these real quick. Nadex will give you a free $25,000 demo account. That way you can get in there and get familiar with the Nadex demo platform and how to enter and exit orders, execute orders. All you gotta do is just submit some real quick information here. Select a username, and then in just a few moments they'll email you a temporary password. You can log right into the Nadex demo platform, and like I said, great place just to get familiar with it, practice any strategies or systems you might be looking at, master them in demo before you move over to your live account. All right, now once you get that temporary password and log in, you can go right up here to my account, and you can go right here to settings, and then right here to passwords. And you can change that temporary password. They give you, something of your own choosing there. But to definitely take advantage of that, Nadex offers a lot of great stuff to their members, a lot of great tools, a lot of free education. That's what these webinars are here for. These webinars are here to just traders helping traders, helping you understand who and what is Nadex, kind of show you some ways that we trade Nadex, how you could utilize them in your day-to-day trading and take advantage of what they offer in their capitalist products. Here under Learning Center, if you want to see upcoming webinars, you can go right here and check out some of the webinars. In fact, if you go in here and you click on webinars, you'll see some of the upcoming webinars you can get registered for. That way, you'll be registered, you'll get email reminders of them. You can see what subjects are coming up, what days and times, get registered for those. You can go back and you can check out, some of these on-demand webinars here. If you've missed some of my webinars in the past here, if you just go right here and click my name right here, John Skelton with Apex Investing, this will pull up some of the past recording webinars, and this is where ongoing webinars are placed as well, okay? And we do everything in here from, very basics to, misconceptions, choosing the right contracts, different trading strategies. It's a very, in-depth library, everything from, basics, and then, setting that foundation and building from there, okay? So just a great place to get some good information there for you. Like I said, my name is John Skelton with Apex Investing. Apex and Nadex, two complete separate companies. Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got live trade rooms and indicators and strategies and systems, step-by-step training courses. A lot of our systems focus on risk management and probability. That's why we love the capped risk products of Nadex. But we're traders just like you. All right, we trade Nadex, binaries and spreads all the time and every day in our trade rooms. And we're a Nadex education partner. Again, just here to help educate you, get you some free education on Nadex. I've been with Apex as head of operations for about 4 years now. I've got a background in banking and as a licensed stockbroker. And again, a trader just like you. So that's what we're here for, okay? So let's kind of jump in. We're going to talk a little bit about how to use Nadex spreads to lower your risk on futures and Forex, okay? Now, we'll build on this some more over time. Like I said, again, today's going to be just a very basic outline for you, for those of you that might be new to understand how you can utilize this strategy. So let's say you're a futures or Forex trader, okay? You trade futures contracts or you trade, spot Forex, okay? We'll talk to you a little bit about, what are Nadex spreads, how they work, and how you can utilize them and what instruments you can utilize them to help hedge those positions, all right? So let's walk through that just a little bit here. Let me talk to you a little bit. Let's do a brief overview of what are Nadex spreads, okay? And if you want a little more in-depth, training on that, remember I showed you right here, you can go back and check out these recorded webinars right here. Basics of Nadex spreads. That's a whole complete webinar just on the basics, okay? And then you can go in and get, there's several other webinars in here that dig a little deeper into Nadex spreads as well. But we're gonna do just a quick basic overview to set the tone here. I'm gonna show you some examples here of how to hedge. And again, just kind of give you the basics here. But spreads, I like to call them box spreads, because if you draw them on a chart, that's what they look like. They look like a box, okay? They have a top and a bottom, or what we call a ceiling and a floor, all right? And all of the products with Nadex are capped risk. You cannot lose any more than what you put up to get in the trade. Your risk is the initial cost to enter the trade. And I'm going to show you how that works as well, okay? And Nadex offers spreads on various stock index futures, commodity futures, and cash Forex. So just real quick, here's how spreads work, okay? Spreads have a ceiling and a floor, or a top and a bottom, okay? And let's just say this was an example of the euro dollar. Let's say the floor was 1.2400, the ceiling was 1.2500, okay? So that's the top and the bottom, the ceiling and the floor. The spread is the difference between the floor and the ceiling. So this particular spread is a 100 pip spread, all right? So the quote here, the Nadex indicative, moves in pips or ticks, right? Pip or the tick is the last digit quoted. In this case, euro dollar, Forex, it's a pip. All right, each pip is worth $1 at expiration. Okay, there's 100 total pips in this spread, but each pip at expiration is worth $1. Okay, so let's just say I was selling a spread. Let's say I had a short bias, the market was going short. Okay, well, if I'm right and the market does move down and goes short, I can only make money to the floor. Again, it's like a box. It boxes you in, right? Okay. It determines your potential profit and potential loss. It's not unlimited, all right? Which is a great thing, again, with all Nadex products being capped risk. So if I was selling going short and the market went short, wherever I sold at, I would make money down to the floor. The market kept going down below the floor. I don't make additional money below the floor. I'm capped here. But let's say I'm wrong and the market went up. It didn't go down. I only lose money to the ceiling. Okay, I don't lose, my risk is capped at the ceiling. I don't lose more money past the ceiling. So let's say I'm way wrong. I thought it was going down, but it shoots up 100 pips. Well, as soon as it passes the ceiling, I don't lose any more money. Each tick it goes outside of the ceiling, oh well. Okay, like my risk is capped, I've already hit that cap. So let's just say for a quick example here, that I was to sell up here at 1.2490, okay? Well, I sold at 1.2490. The ceiling is at 2,500. So what's the difference there? The ceiling's at 2,500. That's the most I can, that's where my risk is capped. I sold at 24.90. So I sold 10 pips away from the ceiling, right? Each pip being worth $1. So there are 10 pips. So my maximum risk is what? $10. Okay, that's the most that I could potentially lose on this trade. That's the most I'm risking on this trade. So how much do you think I have to put up out of my account to enter this trade? Again, like I said, your maximum risk is the amount you put up to get in the trade. So I have to put up $10 out of my account to get in this trade. Okay, and what is my potential? Well, I can potentially make money all the way down to the floor. All right, so if I sold up here at 24.90 and the floor is at 2,400, I've got a potential profit area of 90 pips. All right, $1 a pip, so $90. Okay, that makes sense? Now, let's just say, for example, I sold right here at 24.90 and the market comes down to 24.50. And that's when I get out, or that's when the that's when the spread expires. So if I sold at 24.90 and I got out when it was at 24.50, what's that difference from 24.90 down to 24.50? Well, that'd be 40 pips, right? And if it's $1 a pip, that would be how much? $40. Okay, so does that make sense? It's $1 a pip at expiration, or it's $1 a pip from where I buy, sell compared to where I can buy back. All right, let's get another example here just real quick. If I was to buy the spread, let's say I had a long bias. I thought the market was going up. Well, it's the same type of situation. If I'm right and the market goes up, I don't make additional money above the ceiling. But if I'm wrong and the market goes down, I don't lose additional money below the floor. Okay, and I don't get stopped out. What do I mean by that? Just because the market hits a ceiling or hits a floor, it doesn't automatically close my trade. The trade stays open, right? I mean, look right here. So I thought the market was going up, but let's say the market comes down and it hits the floor and goes past the floor. It doesn't automatically close my trade. My trade is still open. And I'm glad. Why? Well, because the market comes down, and then what does it do? Then it comes back the way I thought it was going to come back and goes all the way up. You see that? So it's a good thing that it does not close my trade just because it hits one side or the other. Okay? But now, let's say that I bought here at 24.10, okay? And the floor is at 2,400. Well, same type of situation. I don't lose any more additional money below the floor. So if I bought at 24.10 and the floor is at 2,400, I bought 10 pips away from the floor. So each pip is worth $1. There are 10 pips. So my max risk is $10. That makes sense to everybody? Okay. So what is my max potential gain? Well, again, I bought down here at 24.10. I can make money all the way to the ceiling of 2,500. So I've got a potential profit area of 90 pips, each pip being worth $1. Therefore, potential profit of $90. But now let's look at something, okay? Say I bought right here at 24.10, expecting the market to go up, but the market comes down first, right? We've all had that, right? We think the market's going one direction. We buy, and as soon as we buy to go up, what does it do? Starts to come up, no, we're gonna go down. And it goes against you, right? And it knocks you out. It hits your stop. You have to get out of the trade with a loss, correct? And then after you get out with a loss, what does it do? Then it goes back in your favor. And you get upset and you get frustrated and you think the whole market's out to get you, right? We've all been there. Notice with this Nadex spread, I bought here at 24.10. It did pull down against me. But once it comes down here to the floor and I'm down my max loss of $10, I'm like, okay, oh well. as it's going further and further against me, I'm not getting further and further in the red. You know what I mean? But then it doesn't automatically close my trade, which again, I'm glad, because when it comes back in, then it starts going my direction. I'm getting profitable. Make sense? But when it gets up here to my ceiling, and especially after it passes my ceiling, do I make any more money past the ceiling? Can I make any more profit past this point right here? Who can tell me, yes or no? So I bought down here. It's come all the way up. Do I make any money past this ceiling? Yes or no? No. But again, it does not close the trade just because it hits the ceiling. Is it probably a good idea for me to consider that I close the trade out after it's up here and after I'm at around my max profit? Yes, because what could happen? It could come back down. You see that? Okay. So when it's going against you, you're glad that it's the trade staying open here, right? Just because it hits that floor, you're glad it stays open, because then it could come back in your favor. But when it gets up to your max potential profit area, it's probably a good idea to manage that trade, right? Otherwise, what can it do? It could come all the way back down, right? Okay, so that's the beauty and the power of the capped risk, or what I call a box. Does it make a little more sense now why I call them box spreads? Because you're boxed in there and you're protected, okay? You know where your limits are. You know where your floor and ceilings are, okay? So that's an example of buying a spread and selling a spread. Now, you can close the spread out at any time, okay? Or you can let it expire. Spreads have expiration times. They start at this time, they expire at this time. Okay, so if I bought it, here and I want to get out of it up here, or if I, bought it here and I want to get out when it's here, okay, whatever the difference is of where I bought or sold compared to where I get out and buy or sell, that difference of pips times $1 a pip, okay, is my potential profit or loss. All right, let's say that I bought the spread right here at 24.50, okay, thinking it's going to go up, but then the market comes down 30 ticks and it's down at 24.20. It went down against me 30 ticks and I decide to get out. Say, hey, I was wrong. Then how much would my loss be? If I bought at 24.50, thinking it's going up, but the market went down 30 ticks to 24.20, so I get out. Well, then I'm down 30 ticks times $1 tick. I'm down $30, right? I didn't have to just let it sit and go all the way against me and take the full max risk. I could have gotten out either way. And if I leave it open, then when the spread expires, it will close at the settlement price at the time of expiration. Okay, so wherever I bought or sold compared to where it expires, times $1 a tick, either profit or loss. Pretty simple how spreads work, okay? And the settlement is based on the underlying market, okay? So let's take a quick look here and do a comparison of, trading spot Forex versus the Nadex spread, all right? Now, some of you may trade regular spot Forex. This is kind of an example here of like a pound dollar chart, all right? Let's say that we were trading a full lot of, spot Forex, okay? And let's say that we had like a trend line drawn here, right? So we had our high and then it came here and then here. Let's say we had a trend line and we're thinking to ourselves, okay, so the market came down and pulled up to the trend line, came down and pulled up, came down and pulled up, came down and pulled up. And I think the market's going to keep going short, right? Some of you have traded trend lines before. So let's just say that we're trading this pound dollar chart. We see the market coming back up to our trend line. We want to go short. So what do? Well, we say, okay, right here, we're going to sell, right? And we're going to say this was the most recent, big swing high. So that's where we want to put our stop. So I'm going to sell here, saying the market's going short. But if I'm wrong and the market comes all the way up here, against me, then I'm going to get out, right? Because I have to have a stop, right? So I think it's going to keep going short, but if I'm wrong and it comes up here to this red line, I'm going to get out with a loss. So I sell right here, okay? See over here, see the pricing? So I sell right here at 56.85. My stop is up here at 57.50, okay? Now to trade a full lot of, you know, spot Forex, I had to put up $3,100 in margin. Like that's how much I had to put up out of my account, right? Okay, and we're talking like $10 a pip. So I'm risking $650. From here where I sell, all the way up here to my exit where I would get out, I'm risking 650 bucks. Okay? So, make sense? So I sell. I sell right here, and what happens? The market starts to go down in my favor, right? So I sold here, it starts to go down in my favor, and then what does it do? Boom. Pulls back up against me, goes and hits my stop, gets me out, and goes even a little bit further. And I'm down 650 bucks. Show of hands, put it in the question box. How many have had that happen? I sold. I thought the market was going down, so I sold. And as soon as I sold, starts to go down my direction, then boom, pops all the way up against me, takes me out, hits my stop, I get out, and then, bam, goes back down in my favor, in my direction. And you're just furious. Yep, we've all had it, right? You were right. The market was going down. It just had to make a little trip up north real quick and get everybody's stops there and come back down. And you're frustrated because you lost 650 bucks when you could have been up quite a bit because you were right. We've all had this, right? It's one of the most frustrating things in trading, isn't it? Yeah. So you see what happened there? You were right. It was going your direction, but it went against you first, knocked you out. You're down 650 bucks. Now let's take the same scenario. And let's say we were trading it with a Nadex spread instead of spot Forex. So same scenario. We've got our trend line. Right in here, we want to go short. And we found we have a spread that has a ceiling and a floor. Remember? So we want to go short because we think the market's going down. So we sell the spread right here. Okay? Let's say the spread goes down 250 points. Okay? All the way down to the floor of it, which is 54.50. So we sell the spread, okay, right here at 56.65. Okay, so we sell right here. We sell that spread. And what did I just teach you earlier about spreads? If I sold right here to go short, and I'm wrong and the market goes up, where do I stop losing money? At the ceiling of this spread, I do not lose anymore, correct? Even if it keeps going and going and going. I can only lose from where I sell up to the ceiling, correct? Everybody see that? So from 56.65 up to 5,700 is how much? $35 of risk, right? But now, to make this example fair, remember, it's $1 a tick. The example I showed you a minute ago, spot Forex, was $10 a tick. So we're going to say that we're doing 10 spreads to equal it out. That way it's still $10 a tick, okay? So we got 35 points of max risk. We're doing 10 spreads. So our risk here is only 350 bucks. What was our risk on the spot Forex way up here? 650, right? Our risk here is only 350, and that's it. How much did I have to put up to get into that trade on the spot Forex? Like 3,100 bucks, right? I only had to put up like 350 for this trade, 10 times less. So I enter the trade and I go short, boom, market does the same thing, pops all the way up here. How am I feeling right now? It already came to my max loss. It already came to the ceiling. I'm already down my max risk right here. And the market kept going and going against me. Is my trade closed out though? Remember what I told you, just because it hits that floor or ceiling, it doesn't close out the trade, does it? That trade is still open, right? But what did you have to do on your spot Forex? You had to get out up here, right? You can't handle it going against you and against you and against you, right? You'd have unlimited potential loss. But here, we sold to go short, it comes back, hits our ceiling, we've hit our max loss. Every pip is going past it. Okay, well, I'm not losing anymore. But my trade is not closed out. It's still open, and I'm glad. Why? Because boom, it ends up coming back into the spread, back into work, and in my favor, and it expires down here. And it expires at 1.5589. And I had 10 contracts. I ended up profiting $760. Do you guys see that difference there? Of how having that capped risk with the Nadex spread actually protects me there, and it lets that market go against me and do its pullback, and then when it comes back in my favor, I'm still in the trade, but I didn't take on all that extra risk. And in the end of it, trading the spot Forex, I was down 650 bucks. Or I'm sorry, my risk was 650. On the spread, it was only 350. I had to put up margin, I had to put up 3,100 bucks out of my account to trade that spot Forex. But on the spread, to trade 10 of them, I had to put up like 350 bucks. And in the end of that scenario, I lost 650 trading the spot Forex, but I profited 760 trading the Nadex spread. Do you guys see the difference there? Do you guys see the power of that capped risk, of how that floor and ceiling protects you? Okay. Now, I'm not sitting here trying to give you a sales pitch to not trade spot Forex. Okay. Although I think when you kind of see this for yourself, you'll see the power of that potential there. But I want to give you another example here. Now let's piece it together real quick. Okay. Let's piece it together. So let me skip through this. Okay, I'm going to show you something else. So back to our first example. Let's say I'm trading spot Forex and I want to go short on my spot Forex right here. Okay. So remember, I'm going short on the spot Forex. What if I could find a spread that had a bottom or a floor right here at 1.5700, okay? And way up here, it had a ceiling at 59.50, so the 250 pip spread, okay? Hear me out. Same trade, I'm going short, and I'm gonna go short with my spot Forex. But what if I could find spreads? So I'm going to go short here, but what if I could find spreads that had a bottom right here? Okay. And I could buy these spreads. Okay, the bottom is 5,700, but I could buy them at 5,710, right in here. So my risk on the spread is 10 bucks per spread. I'm going to buy 10 of them. So I got to put up $100 to buy 10 of these spreads. Make sense? And if I'm buying this spread, that's saying the market's going to go up, right? But I'm not looking to go long. I want to go short still, correct? Okay. So what happens in this situation? I still sold my spot Forex, okay? remember I sold the Forex here, and when the market popped up here, remember before it took me out. I had to exit my spot Forex contracts. So if I sold my Forex right here to go short, when the market's going against me, I'm losing money on my spot Forex. Everybody agree? Does everybody understand that? If I sold Forex here to go short, but it comes up against me, I'm losing money on my spot Forex. Yes? Everybody agree? Make sure you're following me here. Okay. But what happens when the market gets up in here to 57.10 and then keeps going? I'm losing money every pip on my spot Forex, but I'm making money every pip on what? On this Nadex spread. Does everybody understand that? Does that make sense? So I'm hedged. Do you see that? Where did I buy these spreads at? At 57.10, right? So as the market's going 57.11, 57.12, 50, I'm making $10 a pip on the spread, correct? At the same time, I'm losing $10 a pip on the Forex. So I'm even out. I'm net neutral, right? Does that make sense? I'm not really gaining or losing overall. And how big is this spread? Remember, this spread went up, how far? 250 pips. The market could literally go against me up here almost 250 pips. And I'm neutral. Does that make sense? Even though I'm losing that on one side, I'm making it back on the other side, so it evens out up to like 250 pips. So where is my real risk in this trade? Well, where do I start getting hedged at? Right here, right? At 57.10. Okay? So I sold the spot Forex at 56.85, right? I bought the spread at 57.10. So that's a difference of 25 pips. And it's $10 a pip. So my true risk here is 250 bucks. It's from where I sold one to where I bought the other. That gap, that difference is my risk. So my true risk in this trade was 250 bucks total. You see that? Remember the first example where I was down 650? Here, my true total risk is only 250 bucks. And not only is my total risk only 250, but I've got a stop of like 250 ticks to still only have a $250 risk. Because I'm hedged and covered all the way up to the ceiling of this spread. You follow me there? Did I lose anybody? Raise your hand if I lost you. Does that make sense? Okay, and that's what we call the ultimate hedge strategy, utilizing the capped risk power of the Nadex spreads. Okay, let me pull up a chart here. Here's a chart right here of, it's a current chart right now, okay, of YM, the Dow, okay? So let's just put it into perspective one more time here. So we see right here the market's what? Going up, pulling down, 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 right? So right here it pulls down, and then this bar closes back up. So let's say that you were biased to go long again right here, okay? And you wanted to enter a, YM, a Dow futures contract right here to go long, okay? Makes sense, right? Market's going up, it's an uptrend, right? Up, pull back, up, pull back, up, pull back, up. So you want to go up with the market, okay? But you want to also protect yourself. And let's say that you could have found, in that example, let's say that you could have found a spread, okay, that went like this. So you're buying spot Forex here, or spot future here, futures contract here to go up. But you found a spread on Nadex that had a ceiling right here and a floor down here to go short. And let's say that you were able to sell that spread, somewhere right in here, okay? So your risk on this trade, and let's say that this spread went down, 100 and, let's see here, 2460, 24,360. Here, let's do it like this. Let's say that this was a 100 tick spread. Okay. So you're long the futures contract. Okay. Yes, Ellen, when I say spot Forex, I mean the Forex market, not Nadex. Okay. Now, I'll say this, Ellen, you can use the big daily masters Forex spread on Nadex as your directional instead of spot future, and still hedge with the lower risk intraday spreads, okay? So yes, you can use the big, you can hedge spreads with spreads, okay? In today's webinar, I'm mainly just referring to futures or Forex, and hedging them with Nadex spreads, but you can hedge spreads with spreads, okay? So does this make sense here, guys? In this example, I'm buying the future contract to go long, but I've, was able to find a spread here that had a ceiling right here and a floor right here, going down 100 ticks. So if I was wrong and the market didn't go up and the market started coming down, okay, where is my real risk in this whole trade? Is from right here where I bought the futures contract to right here where I sold the spread contract. That is it. That difference of, in this example, what would it be? Let's just say 10, let's see here, 10, 15, about 20, let's just call it 20 ticks. 20 ticks is my max risk on this trade. That's my risk on that trade. It's 20 ticks. From there, the market could go down basically 100 ticks, 100 pips, or 100 points here, all the way to the bottom of this spread, and I'm hedged all the way down. Now, I'm not hedged past the floor here because I don't make money past the floor, okay? Now, does that make sense? My real risk is only between where I bought and sold, and I'm actually hedged all the way down here, 100 pips. Now, keep in mind, if I was to have bought this YM, the Dow futures contract, can anybody tell me what that ticks in? How many dollars a tick is a Dow futures contract on the futures market? $5 a tick, right? On the E-mini, okay? On YM, it's $5 a tick on the Dow, okay? So how many of these low risk Nadex spreads would I need? If one spread is $1 a tick, how many Nadex spreads would I need to equalize out the dollar per tick to truly be hedged? I would need 5 spreads, correct? Everybody see that? Okay, so guys, that's a very basic beginning foundation understanding of the ultimate hedge strategy, okay? You can find some other videos about this in the archive section, in the on-demand section. We'll also, do some more webinars over this strategy over time. You can also go and check us out at apexinvesting.com if you have any questions on that or to get some more information as well. But it's a great strategy, for futures and Forex traders to, hedge their positions for, pennies on the dollar. Like I said, you can also use the big daily master spreads as your directional trade and use the shorter term Nadex spreads as your, the low risk ones as your hedge. Okay. So guys, I know you probably have a lot of questions and you want to dig deeper into this, and we will do that. But this is just kind of the basic understanding of what is the ultimate hedge strategy. Okay. All right, guys, thank you so much for being on the webinar with us today. I appreciate you being on. I appreciate your questions and feedback. Make sure to hop on over to the upcoming webinars, get registered for any future webinars there so you can get reminder emails about it. And we will see you on the next webinar here. All right, guys, thank you so much for your time today. I appreciate having you. Have a great one.